tutorial on how to trade smash bars. In this section we'll look at what smash bars are, how we use them, and when do we use them. So what are smash bars? You've probably heard of these as hanging men before. They're essentially pin bars, bullish pin bars and bearish pin bars, but they're counterintuitive by nature. But we can take advantage of this, providing we have a level in the way. As usual, with trading opportunities, they arise when we have key levels of support and resistance. But what is a bearish smash bar and what is a bullish smash bar? That is the question. Let me show you. A bearish smash bar is essentially where we get a low test bar or a bullish pin bar heading into a level of resistance. This level of resistance could be a hard level or a soft level, it doesn't really matter. But where we're expecting to see a high test bar here, interacting with the level where sellers are coming back into the market, we in fact have a low test or bullish pin bar reversal. This is what's so counterintuitive about it, and what we're looking to do is go short thereafter and have our entry below the low of this low test bar and our stop loss above the high, because in this case we're relying on the fact that the low test into this level is a sign that we are overexhausted, and that if we do have our entry below the low of this bar and we get triggered in, the bulls which initially defended this level are no longer there to defend it. So it's like a hole through the floor with carpet on top essentially. And it's the same principle for a bullish smash bar as well, except the other way around. We've got sellers coming to a level of support, hard or soft, and we've got a high test bar or a bearish pin bar. Now, most of the time we'll expect to see on this level of support like a low test bar, which is bullish, given that we'll be looking at sellers taking profits so the bulls come into the market as they perceive value at such levels. However, if we've got a high test or a bearish pin bar here, then what we could do is again treat this like a level of exhaustion and anticipate a sudden tirade of buyers come into the market. And the safest way of entering that would be to simply have our order above the high of the bearish pin bar with our stop loss below the low. So that if for the next day or the next moment in time, the next bar, we are triggered in, then at least we could say to ourselves that the bears, the sellers in the market, which initially caused this pin bar to close as a pin bar, they're no longer there to defend the level. So then the bulls can have a free run upwards. Let's demonstrate a few examples, but I just want to make sure you get the theory first. So a bearish smash bar is a bullish pin bar or low test, you might know it as, closing into a key level of horizontal resistance. It could be a soft level or a hard level. It doesn't matter about the color. Like with most instances where we're looking at pin bars, the color doesn't really mean anything. However, it's all about where the open is in relation to the close. So we've got New Zealand yen here, and we've got a key level at 69, which is a round number. And we've got a low test bar or bullish pin bar closing into that level. Now, as we're in a range-bound market at the top of the range, we would reasonably expect to see a high test bar there. However, we don't. We see a low test bar there, which to a few people in the market would be a bullish sign. However, to us, we're going to simply speculate in the safest way possible that if the low, the next day, of this low test bar or bullish pin bar is breached, then we can reasonably say that this is a sure signal to go short. As we can also see on this chart, this level which it's coinciding with is a round number, 6900. The level's been unbroken for over a year. Not a bad entry to go short, quite frankly. However, what you'll notice as well is we look at the same criteria for going short or long on smash bars as we would regular pin bars anyway. You see it's up against this level, we've got a big number at the top of the range or 2-year price extremity. That's enough evidence to potentially go short. But remember the irony. A bearish smash bar is ironically a bullish pin bar or low test. If you look at a bullish pin bar on its own at any chart and isolate it from the rest of the price action, you could reasonably say the fact that it's low tested, closed as a bullish pin bar, it's a sign that the buyers will come into the market. However, if it's closed into a level, we can expect this level to override the price action in this instance on its own. And we can expect this to thwart the buyers and sellers will come running into the market, so we can place our orders to go short below the low of the bullish pin bar, like we've just demonstrated. If we're triggered in for the next day, if we're trading the daily chart, or in the next period of time, if we're trading the hourly or whatever, then great. We'll manage to trade accordingly, and we'll talk about that more in strategies. If we're not triggered in for the next period of time, then we can say the trade's invalidated itself. And you could quite often see that if we're not triggered into the trade, that price will just slice through the level like a hot knife through butter, and we can just forget about it and move on. At least we're not triggered into a losing trade. So what happened with New Zealand yen? Let's find out. Here we go. We had the bullish pin bar, bearish smash bar, also known as, and we can see the next day triggered us into the trade, and this gave us, over the next 3-4 weeks, a decisive downward move, which we held on to. And quite a lot of the times, if taking trades at such strong levels, you have to be more patient with how long you have to wait. That's not a bad thing, right? You can just walk away from the trade and simply enjoy lifestyle instead. As the low of our activator bar, or bearish smash bar, was breached, we were triggered into the trade, which confirms the fact that it's a smash day or a smash bar, and that the bulls which were once there to defend the level, where the low of this bullish pin bar was, they're no longer there at the point where the next day took out the low and triggered us into the trade. And of course, we had the technical level of resistance on our side here. As you might remember in the previous module, the bounce is 70% more likely than the break. So pure logic would dictate that even if we didn't have a smash bar, we would be looking for a short way off this level anyway, given that it's a 2-year high. So a bullish smash bar. Moving on, this is the flip side of the coin. This is a bearish pin bar, also known as a high test to some people, or even a morning star, depending on what books you've read, who you've listened to in the past. And they typically close into key levels of horizontal support. It could be a soft level, it could be a hard level, and once again, it does not matter about the color of the bar. It's all about the profile of the bar, and whether it's got a tail and a head. In this instance of CAD Swiss, we have a well-defined range here. You can see price action very nicely bouncing along these previously established levels of support resistance. And we've got a bearish pin bar right here at the bottom on the level of support. And whilst if we are trading the bounce, we'll be looking ultimately for a bullish pin bar. We don't have it. We have a bearish pin bar. However, smash bars are counterintuitive by nature, so what we could do is, granted with the probability we have of the bounce off the horizontal level being 70% more likely than the break, we could have our order safely placed above the high of this bearish pin bar, stop loss below the low, and only be in the trade if the sellers or the bears in the market are proven to no longer be there at the high of the pin bar. And will only be in the trade if this high of the pin bar is breached and they are proven not to be there. So it's a very safe entry, which we will only be in if the sellers aren't there and the buyers take over and prevail. Value is perceived to buy on strong levels of support. But again, you note the irony. At horizontal levels of support, you would typically expect to see a bullish pin bar or a low test bar. However, we've got a bearish pin bar, also known as a high test, but on a level of support where we can reasonably expect to see people who are already short taking profits and the bulls coming back into the market. And our entry above the high of the bullish pin bar is a very, very safe entry, because we would only be triggered into the trade long if the high of the pin bar is breached, and thus the bears, which initially caused this pin bar to close as a bearish pin bar, are proven not to be there, or no longer there. And this will only be proved once the high of the bearish pin bar is taken out. However, if price action does just resume and go down short, however, if price action does resume and just bust through this level here, it doesn't matter, it's fine. The smash bar has failed to materialize and the setup is now invalid. And guess what? We won't be triggered into the trade, more likely than not. We can just happily be ourselves out of this trade which has failed to manifest itself and execute. Let's see what actually happened for CAD Swiss. See if the bulls are no longer in the market or the bears are no longer in the market. Who knows? We'll see. There we go. So the high of this bearish pin bar was breached, in fact, and this range has further confirmed itself. The bars are coming to the market at this level of support. The high of this bearish pin bar has been breached. Our trade has been triggered, and we're happily long and would most likely take it up to 3/4 of the way up the range for a high probability, lower reward outcome, with no bears in the way seemingly. But for your information, we only trade smash bars, bullish and bearish smash bars, if we've got a horizontal level in the way. So it's not so much about the smash bar itself, it's about being aided by key levels of supply and demand. The perception of value to buy and sell amongst the buyers is as strong as any other reason. We just use the smash bar itself, i.e. the bullish smash bar at a level of support. You might know this as a level of demand, or a bearish smash bar at a key level of resistance, otherwise known as a level of supply. So when do we use them? At price extremities, key levels of support and resistance, hard or soft, by the way, like we just mentioned. We look for the similar criteria as pin bars, essentially, to assess the viability of the trade case by case, but more often than not, pin bars can also be traded with moving averages, whereas we recommend the smash bars have more of an emphasis on horizontal levels here. And as the adage goes, the stronger the level, the more likely a successful trading outcome is. And we can trade these whenever they manifest themselves. Rest assured that it's a very safe entry indeed.